Hello, and let me set my timer here because I'm still on just 30 minutes. All right. So we're moving into merchandising operations in the multi-step income statement. Merchandiser, of course, are companies like Walmart, Home Depot, Publix, any company that buys manufactured or agricultural products and then sells them to the consumer. So they're a middleman, basically. Those are merchandisers. So somehow we have to track inventory. How do we measure income? All right, so we have sales revenue, and this is going to introduce one other concept of the multi-step income statement. Before we've looked at it's just been revenue less expenses equals net income. We're going to expand that. For a merchandising company and a manufacturing company, you have sales revenue and then you have cost of goods sold, and it equals gross profit. That's a very highly watched number. You have a company like Walmart that has $673 billion in sales. The even 1/10 of 1% is worth millions of dollars. So the gross profit margin, which is the percentage of basically how much you keep to use for other expenses. So sales revenue less cost of goods sold is equal to gross profit. So how much of that? How many dollars? So if Walmart has a gross profit margin of 55%, then they keep 55 cents of every dollar of sales that they use to pay for other expenses. So again, gross profit now to cost of goods sold for a merchandising company is means it's inventory. So every time you go into Home Depot, and let's say that you buy a saw at Home Depot. Home Depot right now has that saw in inventory. When you um, click on, scan your product, then what happens is that Home Depot will upload transactions into their accounting system. They'll record the sell of however much the saw was. They'll record cash because you're probably paying with cash, check, probably not check, but a credit card. They will deduct this amount from inventory and then they will move that same amount to cost of goods sold. So you've taken an asset and it's now expense because you've sold it. How do you compute cost of goods sold? Well, in some ways, you start with what you have. You add what you bought, okay, and that's the amount of goods you have available to sell to the public. And then at the end, you're going to take account of your inventory. How much do I have left? And so the difference is cost of goods sold. And companies will either use a perpetual inventory system or a periodic inventory system to account for inventory. A perpetual system means that every time you get inventory or you sell inventory, you will record that. So theoretically, at any time, you will know how much is in your inventory. Now, I just went up to Home Depot and I built some shelves. So I wanted what's called a shelf spoon. And I like Home Depot because their app shows them how much they have in inventory. But it was wrong. They had zero in inventory, where it said they had 30. So I went to them and they said, well, that's a mistake. So now they're going back and changing their inventory to account for whatever happened, which is called shrinkage, and we'll talk about later. But it keeps detailed records and it continuously records. So perpetual. Perpetual means continues on forever and ever. Okay. And the company determines cost of goods sold every time a sale occurs. Periodic means every so often. So what I'm going to do is every so often, which is every month, I'm going to count my inventory. And then I'm going to use that first equation. What did I start with? what did I add that's cost available for sale? Now I'm going to count my inventory. The difference is going to be cost of goods sold. So periodic means that I have to every month take an inventory. Perpetual means I still have to take an inventory every so often, maybe once a year. Some companies use both. Really depends. I mean, Walmart, I can't see that they have to, I think, use a perpetual. Otherwise, they would be inventorying every month of billions of dollars and billions of items, and that's just not feasible. So they have to have a computer system. Now, if you were a pianos company, you're not going to sell that many pianos, so it's probably not that difficult to keep your inventory. Recording purchases. Okay, your basic purchase means that you're increasing inventory. Okay, well, how did you pay for the inventory? Well, I either paid cash or I am going to borrow, going to pay them uh, accounts payable, so I'm increasing a liability. I'm going to pay them in a month. And a purchase invoice should always support each credit purchase. Cash purchase should be supported by canceled check. And again, you increase inventory and you decrease either cash or you increase a liability. And eventually you will decrease that liability, decrease cash because you'll pay off your accounts payable. And so here is the inventory. So what we've done here for the perpetual system, we've increased inventory and we've increased accounts payable. One point me is FOB shipping point. All right, so the FOB, free on board. The whatever's after that is the point at which the title of the merchandise shifts to the buyer. It also determines who pays the freight. So FOB shipping point means that at the shipping point, the title is transferred to the buyer. And so the buyer pays the freight cost. FOB destination means that the seller pays the freight cost and the buyer doesn't take ownership of the goods until they're at their dock. Why is this important? What happens if something happens in transit? The truck gets stolen. If you're the buyer at its shipping point, you're responsible. You have to go through the hassle of filing a claim, reordering the merchandise, etc. If it's FOB destination, that means the seller still retains title, and so they're the ones that will have to deal with the police, etc. Now, what do you think if you're an Amazon customer and if you are a Prime member where you get free delivery, which of these do you think would apply to that? And I would say it's FOB destination. And if something happens, you can return it to Amazon. They'll take responsibility for it. And Amazon, if you're a Prime member, pays the freight costs. So for Amazon deliveries, you're the customer. You are under FOB destination because you don't take title until you receive the merchandise. Freight cost. If it is FOB shipping point and you pay the freight cost, those costs are part of your inventory because the inventory includes the cost of inventory and the cost of getting it to your warehouse. So freight in is part of your inventory cost. Freight out is an expense. So FOB destination to me means that Amazon's paying the freight costs. That's an operating expense. That's not part of the inventory costs. So you see here that the inventory is increased because you are FOB shipping point. So inventory costs should include all costs to acquire the inventory, including freight necessary to deliver the goods to the buyer. Companies recognize these costs as cost of goods sold when inventory is sold. Now, again, freight costs incurred by the seller to get the merchandise to you is an operating expense, which decreases retained earnings. So your inventory is all the transactions involved for your inventory. If you return an item, then what normally happens is you will decrease your inventory by whatever the item was returned. So your net is that you didn't get that. A purchase allowance may be a situation where, hey, I got something damaged. And so, well, rather than handling that, we're going to give you a discount, but it still lowers your inventory cost. Now, one year, my wife bought a painting for $100, and what they shipped us was not the painting we ordered, and it was terrible. So they said, well, just keep it. So I wonder how much they paid for it. It would cost them more for us to return it to them than it did for them to buy it. So they just said keep it, but we hated it, so we donated it to Goodwill. Hopefully somebody else would like it. So a purchase return, a purchase allowance decreases your inventory. So you see here, inventory goes down and what you owed them goes down. When goods are purchased for resale by a company using a perpetual inventory system, it increases inventory. Discounts, again, also, well, we're going to give you a 3% discount. Sometimes they do. So we have this other term here. It's 210 in 30, 210 net 30. So this is 2% discount if you pay within 10 days. If you don't pay within 10 days, you pay the full amount, net amount in 30 days. All right. And if you work this out financially, it's a good deal to go ahead and get the discount. But most companies, they just say, hey, we'll pay by 30 days. It just really depends on the company. So let's say that I buy something for $10,000 and 210 net 30. So I buy it on January 1st and I pay the vendor on January 9th. All right, so that's within the 10-day window. So I get the 2% discount. So I don't pay them $10,000. I pay them 9,990 or something like that. Anyway, but if I pay them outside that window, so if I buy it on January 1st, I pay them on January 28th or even January 11th, I'm not in that window, so I would pay the full amount of $10,000. So first one is the discount number. Second is the days. Third is when if you don't take advantage of the discount, you have to pay it in 30 days. 110 end of month was 1% discount if you paid in 10 days. Otherwise, you have to pay it in the end of the month. So you can see here, all right, what happens when you add inventory. When you initially purchase it, here must be the freight in. This is the discount for the returns, and this is the discount for the allowances. So you should know items that increase and decrease inventory. So buys merchandise on account, the purchase price $1,500, the cost of DI is with 800, used effective goods with a selling price of 200, use a tabular summary to record the transaction. So first we bought it, then we wanted discount because of damage. So inventory declined, and so did our accounts payable. This is just, again, sales invoice. Pretty much the same thing that we're talking about. Okay, so again, is we as a seller, if we sell inventory, um, in this case, we are going to either debit an accounts receivable, which is an asset, and that means they owe us money, debit cash because they paid us, or we're going to credit sales revenue. We will also increase cost of goods sold and decrease inventory. So every time you scan with that, at whatever store you go to, that automatically posts to the accounting system. And so this is really the other side of purchasing. All right, so prepare multi-step income statement. Multi-step, again, initially we said we have sales, expenses, net income. Multi-step is we're going to break it down to provide more detailed information. We want to know gross profit, okay? How much of the dollar do we keep to pay for other expenses? We want to know what do we keep after paying all the expenses for operations for our normal business. Walmart is in the business of selling merchandise. They're not in the business of selling real estate, but if they happen to sell a building and make a profit, that is part of their profit, but it's not income from their operations because that's not their primary business. So we have gross profit, we have income from operations, and then we have other items like interest revenue, interest expenses, gains, losses. So that's between item 2 and 3. And then we get to net income, which again is the net income divided by the sales amount to get net income percentage. And Walmart, again, only gets to keep about 2 cents for every dollar that they sell. So here is an income statement: net sales, cost of goods sold, gross profit, operating expenses. Payroll is usually the biggest expense of any company. General and administrative and occupancy, so that's rent. So we have income from operations, we have other revenues and gains, we have other expenses and losses. So we get down here to income before income tax, then income tax expense and net income. So again, you see here where cost of goods sold from net sales, cost of goods sold, um, gross profit. And then gross profit percentage, if we divided that 144 by 460, that would give us really what we keep per dollar. So let me break out my financial calculator here. And that's 144 divided by 460, which is our revenue. And so that's 31%. So our gross profit margin is 31%. So we're keeping 31 cents out of every dollar of sales that we'll use to pay for other expenses. And so then we subtract the operating expenses from gross profit. So we had 460 in sales. So let's look at what our income from operations percentage is. That's 30,000 divided by 460,000. And so we're now keeping 6.5 cents for every dollar sales as operating income. Non-operating activities consist of various revenues and expenses and gains and losses that are unrelated to our main line of operations. Again, Walmart selling real estate would be part of this. When non-operating items are included, the label income from operations or operating income precedes them. Because we want to know how much they make on their core business, because that's why we buy it. So here are some other revenues and gains: interest revenue, dividend revenue, rent revenue, gain from the sale of property, plant, equipment. Other expenses would be interest expense, casualty losses, vandalism and accidents, loss from the sale or abandonment of property, loss from strikes by employees and suppliers. Multi-step income statement shows each of these except D. So here is just, again, the profit margin. Here are some industry profit margins. You see that gross profit margins, software, Microsoft is 74.8%. Pharmaceutical, this is why drugs cost so much, because their profit margin is so high. Although their R&D costs are expensed as they incur them, so that's not quite apples to oranges. Uh, Food processing is down to here, chemical manufacturing, and grocery stores and places like Walmart would be way down here. So gross profit provided by net sales. And then net profit margins, again, this translates. So software and programming keeps almost 20 cents of every dollar of sales, whereas food processing, 6.4. And you're going to look at these from year to year. And one other thing I want to mention is called shrinkage. And so that's when, at the end of the year, even whether you're perpetual or periodic, there's a gap of what you thought you had. Okay. Usually this is probably going to be perpetual. There's a gap. You thought you had this inventory, but you have less than that. And that's called shrinkage. And a lot of it is due to, employee theft, to breakage, but most of it is probably to theft in, oh, I'm drawing a blank right now. Um, but when you keep going and rob a store, you know, that's a huge amount. It's billions of dollars each year. And you may think that it's a harmless theft, but who do you think is paying for that? Who do you think is paying for they have to make money. So they have to factor that into their cost, and that's an increase in the cost of items to you. Um, Shoplifting, that was the term. So shoplifting is an issue. It's an issue that is affecting you. So you are paying for all of the security controls and all of the losses resulting from this. So it is. But shrinkage, again, is the reduction of inventory through theft, breakage, and unexplained items. All right, so that really is the inventory. You're going to need to know how to compute gross profit and gross profit margin, how to determine operating income margin, and net income margin. You'll also need to know, if I say, okay, what items increase inventory, what items decrease inventory, you'll need to know that as well.